You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Monday. This week, I will start a quick series while I am driving across Iceland. I will talk about my favorite stock in each sector. Canadian stock, of course, because it's a fully Canadian podcast. So today we're going to look at the communication sector, consumer discretionary, and consumer staple. We're going to have part 2 and part 3 on Tuesday and Wednesday. And then upon my return on the 22nd, we will have part 4. So before we start, to establish this list, I always start with the dividend stocks Rockstar list. The Rockstar list is a list that I create with my DSR stock screener. So we track like over 1,000 companies, more than 50 financial metrics, and I put on the filter to identify only the companies with a positive dividend triangle. So only like the best businesses anywhere. So that Rockstar list, you can download for free at moosemarkets.com/rockstars. So moosemarkets.com/rockstars, or if you subscribe to my newsletter every month, I'm sending you a free version of the Rockstar list. And our members, of course, have access to a much better version of the Rockstar list because they can modify it. They know exactly which filter I use, and then they can improve it according to what they are really looking for. So let's get started with the communication sector. And let's be honest, in Canada right now, communication sector is really a tough place to be. Maybe we could talk about Quebecor for a second. Definitely not my favorite stock because I kind of like the part that they are milking this cash cow called Videotron, but they are struggling with their media business. TVA and TVA Sports are losing money or not growing at all. So definitely a hard place to be for them. They recently acquired Freedom Mobile in the Rogers and Shaw merger, which is going to open a little bit more space for the wireless services outside of Quebec. But I don't think it's enough to pull the trigger on this one just because of that. My favorite stock in this sector remains TELUS, even though it's a tough one to love these days. The stock has underperformed the market greatly. It's pretty much the same story with Bell. Same concern as usual. We need to get more cash flow because right now operating cash flow metrics are not that great. The telcos in general had benefited from a very low interest rate environment for more than a decade. They racked up as much debt as possible, and then they just promised more cash flow going down the road, but it's not happening yet. So the dividend is safe for now, but payout ratio remains pretty high. So this one, I monitor it every quarter. So not super excited about TELUS these days. Actually, TELUS is not even part of the Rockstar list at the moment because it fails to grow their earnings as of late. Going on to more positive stocks, let's talk about Dollarama for a second. It has been a star on the show for a few times. If you've been following me, you know that I was skeptical about their growth potential moving forward, their ability actually to open new stores. But they are able to do that. They have a pretty clear playbook about opening more stores going forward. So yes, it's a low yield, high growth stock, but very promising. I really like their investment in Dollarcity that is expanding in Central America and South America. Again, similar business model, wants to open a lot of stores to grow organically. They maintain very high margins, and a perfect dividend triangle. So a lot of good things are happening at Dollarama for sure. If you are a patient investor, you may want to look at Canadian Tire and BRP. So ticker ctc.a.to for Canadian Tire, and BRP, it's DOO. do because they're making skidoos, right? They are making recreational vehicles. A lot of innovation over there. Electric recreational vehicles as well. Benefited a lot from the COVID hype. Right now, revenue and earnings are a bit on the downside, mostly because consumers are getting tight. But going for the long run, this one enjoy a strong brand recognition. They're selling their products across the world, and I think there's like more opportunity as long as the economy bounces back. So it may take a few years, but it may reward you big time. The other one, Canadian Tire, pretty much the same story here. Super well established in Canada, but of course, while there is kind of like a base revenue and a base earnings that will be generated year after year, even if we go into a recession, because they sell a lot of like household products and essential stuff, the bulk of like their profit and growth is coming from all the fun stuff. So the extra expenses that consumers are spending when the economy is rolling. So right now it's not the case. So of course everything is like the dividend triangle is weakening, but that's usually a pretty good time to make an entry for a stock. So just putting this one, but you'll have to be patient. Definitely, it's going to be a tough ride for the next 2 years. I still expect a recession. So, I mean, buckle up if you want to go with Canadian Tire. On the consumer staples, I do have 3 names as well. So Couche-Tard, I'm not going to talk about it too much because you know me, I love Couche-Tard. I'm the poster board for this one. But I mean, they're able to grow by acquisition and grow organically at the same time. Right now, they're running through a tough patch. So I think it's an interesting entry point as well. And for the long run, they have such a great expertise and such a great experience to grow and to apply their business model with discipline. I just love how this business is run. Another one that could be interesting, recession resistant as well, is Metro, MRU. Metro, one of the smallest grocery store player. They do have Brunet and Jean Coutu on the drugstore part. So mostly based in Quebec, expanding in Ontario, a little bit smaller, of course, than Loblaws and Empire that has Sobeys. But I kind of like the dividend triangle at Metro. I also like the fact that they have not spun off their real estate yet, so that could be another possibility to unlock value. So this one, I mean, you're going to have to pay a good price because you have to pay for quality. But Metro, I don't have it in my portfolio, actually. It's kind of strange, but it has been one of the favorite stock at DSR for many years, part of like many of our portfolios. So another low yield, high growth stock that could hit your list. The last one, but not the least, a tricky play, a little bit more high risk, high reward because it's a small cap. A bit of a roller coaster as well. So just proceed with caution. And again, as usual, I'm not telling you to buy those stocks. I'm just highlighting the ones that I really like in each sector. So Jamieson Wellness, making supplements and vitamins, ticker JWEL, sorry. So Jamieson Wellness, the problem here is they struggles to grow their earnings. So they grow their sales, they grow their dividend, but earnings are stagnating, slowing down at best. So not that great because they invest massively in brand positioning and in marketing. They want to expand on the international markets, notably in China. It is doing well, but they're really in a phase where they focus on growing sales instead of like growing sales and earnings. So not a perfect dividend triangle because of this, but that could be interesting to follow. Again, definitely a roller coaster. So today, among the 8 stocks that we have discussed, I would say that the safest one is probably Dollarama, Alimentation Couche-Tard, and Metro. The one that has like a high risk, high reward type of play would be TELUS, Jamieson Wellness, and Canadian Tire. And then you have BRP and Quebecor that could be interesting. Definitely BRP has a lot more growth potential than Quebecor, but that's how I would rank them. If you want more ideas like this, you can download the Rockstar list. It's being updated every single month with new metrics. So it's at moosemarkets.com/rockstars, moosemarkets.com/rockstars. All right, Moose, that's enough for today. Tomorrow we are coming back with this quick series, and we are going to talk about the energy sector and the financial sector, and there's a lot of them to discuss. All right, take good care, and don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.